Welcome along to our very exciting interest rate, the Middle East conflict and what it means for your mortgage webinar tonight. My name's Claire Williamson, for those of you who don't know me, and I've got my incredible colleague Aaron here, who you might have interacted with. He is a fantastic human and will introduce himself as well.
Yep. Hey everyone, I'm Aaron. I've been with my mortgage for over a year now, and absolutely loving it. I'm grateful to be part of the family here, and yeah, grateful to be able to talk to you guys and hopefully give some good advice and things to move forward.
Amazing. Thank you, Aaron. He's also a lot cooler than me because he has got a My Mortgage t-shirt on. So
Yeah, repping the
that is
brand.
good. Yeah. So I'm just going to very quickly cover off who we are because we have got some people on here who are not part of our family yet. So this is our My Mortgage family. Yes, we do have some crazy times. We have a lot of fun. We work very hard, and we have a really cool range of different humans who everything very exciting in the My Mortgage world. So we now have 15 in our team. We actually have just employed another couple of wonderful people. So very excited to be heading towards that magic 20 person mark, which is pretty cool. So you will see some new names in the My Mortgage family, and you might have a few new people emailing you. And if you're new here, we would love you to be part of what we're looking to do. So we kind of like to say that we make home loans more fun and less boring. And it's going to be evident today whether or not we can actually hit that target that we have. We're talking about interest rates, and quite a lot of people think that they're very boring. So we'll try and keep things light. We know that there's a little bit of heaviness out there in the world. So as always, we would like to kind of embody the My Mortgage spirit of being eternally positive about things. So Aaron's going to kick us off on sort of what we're going to talk about tonight.
Yeah, it's cool. Thanks, Claire. So yeah, we're going to talk about like the global and the New Zealand economic factors that are happening out there and how it's impacting us here at little old New Zealand. We're going to talk about the recent OCR announcement and what's changed there or what hasn't changed. We're going to talk about some rates, some short, medium, long-term rates, and basically give a little bit of advice on what we think you should do or what might suit your goals. And what, when you're trying to consider a rate, what's the best, what are some considerations you could do to give you the best outlook? And we're going to go through just a couple of scenarios just to say how we structure things differently for different people, as there's no one size fits all in the mortgage world.
Yes, we're very grateful for that. And actually, just to kind of cover off the fact that this is not financial advice. So this is all information that may or may not suit you. If you would like to talk to one of us, you're most welcome. You can jump on the My Mortgage website and we'll talk about that at the end of the webinar. So we're talking about general stuff, but some of it may apply to you. So cool. Aaron.
Oh, yes, I'll jump into the wider economic outlook. So I guess in the news lately has all just been about this tension and chaos in the Middle East and how it's affecting everyone globally, basically. The Strait of Hormuz is a big shipping route, and that's what's generally it's being closed, and it's just making importing stuff into New Zealand just that much more expensive. So while it's in the headlines has been like the fuel cost, it's so much more than that. It's like a whole supply chain that has been disrupted. So things like your building supplies, getting food into the country, all of that stuff gets affected by higher oil prices for shipping and transport, essentially. So everything just gets pushed up, and unfortunately, that hits the consumers hard, and we just have to brunt the impact of higher prices, unfortunately. Even like bonds, overseas bonds, like investors are being really cautious because of this war that's going on, which just then affects the mortgage rates here in New Zealand as well. So there's quite a few things going on, but generally it's because of this uncertainty about what's happening in the Middle East. And unfortunately, we just have to ride it out, essentially.
Cool. And interestingly, there's been a couple of things going on back home that I think are worth covering as well. So what's actually happening in New Zealand? At the start of 2026, I think we felt this real sense of, oh gosh, things are getting better. We heard a lot of commentators talking about things like the property market increasing, about business confidence rising, and about people sort of starting to feel like the wheels were turning again in the economy. And I think that sort of started the year with a lot of positivity. And I think with these big changes that have come through, sense, it has kind of put the brakes on and made people feel a little bit more constricted about making decisions, about things like hiring people, about taking money to be more productive, to have more assets, to make more profit, etc., in their businesses. And so what's really interesting that we've actually got a little bit of a two-pace thing going on now, because we've got offshore inflation being imported into New Zealand. So we've got stuff overseas getting more expensive, making stuff in New Zealand more expensive. But I think we've also got a sense of how do we kind of keep the wheels turning in our economy. And I think that actually bumps through into some of the kind of comments that were made yesterday by the Reserve Bank when they were making the OCR decision, which Aaron will cover in a second. But basically what they're doing at the moment is they're really trying to balance the impact of things being more expensive and causing that inflation pressure to come up and inflation, but also make sure that we keep things moving, we keep productive, and we keep things going in terms of the business space. So it's a really tippy balance. And I think if we were to reflect back on when interest rates started to go up, I actually think they moved a little too late. So if we think about a couple of years ago, maybe 3 years ago, when rates started to increase in the last sort of hiking cycle post-COVID, they actually possibly did wait a little bit too long to increase rates, and things got a little bit out of control before they started to take action. So I think they'll be very mindful of that, particularly with a new Reserve Bank governor at the helm, with a couple of reviews under her belt now, and probably just wanting to make a real, I suppose, impact in New Zealand. So I think, interestingly, that it kind of moves into the OCR hold, which Aaron's just going to kind of cover what happened yesterday at the Reserve Bank review.
So they held it at 2.25, which I think most of us were expecting. Going from the trend of late last year where it was constantly dropping and everyone was thinking, yeah, we're on for some pretty low interest rates here. Obviously, this war conflict in the Middle East has put a bit of a halt on that, with the rising of inflation there and the high unemployment rate as well. There's that to factor in as well. They are pretty cautious on lifting it too high, just with all the other financial pressures that are going on as well. So it's kind of that situation of a wait and see, and we're just going to hold for now, see what the economy is going to do, see what the war's going to do. And yeah, it's just a bit of a hold for now, and that's happening. We're seeing it not just here, but globally as well. Economies are just a little bit uncertain at the moment.
Yeah, totally. So we thought we'd just kind of cover like some of the things that we expected to happen versus what have happened, to see what that change has looked like over the last couple of months. So Aaron, did you want to cover the expectations and I'll cover the changes?
Yep. So late last year, when it was continuing to fall, everyone was kind of in positive spirits, and we expected that to just keep continuing. And we were thinking that mortgage rates were going to get quite low. We were never hopeful that it was going to get to the 2.5% again as it was in 2021. But we thought some low threes were going to be on the cards there. The housing market, so recovering housing market, and the lower testing rates that the banks were offering, so people were able to afford more borrowing. Which is kind of where we're still at the moment, and that the inflation was going to go back into that target range that we wanted, and we kind of got there, we kind of didn't, and then now this conflict has just kind of flipped the script on that one a bit.
Yeah, totally. And I think what we're probably seeing now is that conflict has kind of pushed the cost of things up from the start of this month. So therefore, expectations around potential rising of interest rates is probably coming it's moving backwards. It's moving closer to now than it was earlier in the year. So we're kind of in wait and see mode, but they're definitely pricing in the possibility of rate hikes. And so sort of what that means, I've started to call it the uncertainty tax. So because we don't actually know what's going to be happening specifically in that medium term. So we'll cover this in a second, but the sort of 2, 3 to 5 year rates are definitely sort of pricing in a little bit more increase because it's pretty unclear around where rates are going to go. So banks are kind of covering their margins, making sure that they're not going to be out of pocket, and by that they essentially increase their rates, and that makes it a little bit more expensive for us to borrow. What's quite interesting, though, is that the short-term rates, the 6, 12, and even 18-month rates, haven't moved very much at all since November. In fact, I don't think we'd seen any changes until probably only about 2 weeks ago. And that's a reasonably long time period for things to stay pretty stable, especially as we were starting to get rises in the midterm. So, yeah, it's definitely it is definitely a wait and see, which we've said a few times. But also, I think the Reserve Bank guidance at the end of the meeting yesterday was quite interesting. So they that it's likely to sort of be a bit of a wait and see approach, but they also made a point at the end, which was that they won't hesitate to start some increases if it becomes necessary. So if they can't get inflation within their target band, they will take some action. And I think that statement at the end there probably said, expect rates to increase a little bit more towards the middle of the year rather than kind of the start of 2027, which was probably what we expected early on. Now, I actually think I've just of this, so I might just finish it off if that's okay.
Yeah.
So those short-term rates, as I said, 6 months, 12 months, they're more closely tied to the OCR. So that means that the near-term expectation is reasonably consistent because we kind of know broadly what's going to happen with those rates. They're unlikely to fall further. I think we're getting pretty of that now. And the medium-term rates are more influenced by what's happening in the wholesale swap market. So essentially, the wholesale rates are what banks are borrowing money at. So when those rates rise significantly, did sort of back in March and April, they've dropped back down again now, which is really interesting. So those influence more closely than the OCR what those midterm rates look like. So it's definitely it's definitely interesting just seeing how much more of a rise we're getting there compared to those short-term rates. So at the moment, when we see people taking the 2 and 3 years, rates at those terms are kind of unlikely to be significantly lower than they are now. I would expect we're going to see some increases. The longer 4 to 5 year rates are largely by long-term inflation expectations in global bond markets. So you mentioned those earlier. What is the outlook for those? And so most of the time at the moment we're seeing, unless someone wants a significant amount of certainty and a significant cost over time to be very, very consistent, those 4 and 5 year rates are looking probably a little bit less attractive for the average borrower, but we do have some caveats on that, so we will talk about that a little bit later. So to kind of cover off how rates are being affected at the moment, short term, relatively connected to the OCR, relatively stable and has been 6 months. Medium term, more connected to the wholesale swap rates, definitely seen an increase in those, pricing in a little bit of kind of uncertainty tax. Long term, driven by sentiment, long run inflation targets and expectations, and kind of global bond markets as well. So there's sort of 3 very distinct buckets there, and we're going to talk a little bit at the end about how to kind of pick those interest rates and how to make sure that you've got the right fit for you and the right fit for the kind of level of risk that you're wanting to take. So what should you consider when you're choosing your rate, Aaron?
Well, let me tell you. First of all, it just depends like what your goals are, essentially. It's not always about chasing what the cheapest rate is, because that might not be anything to do with your goals, essentially. So are you thinking of, like, are there any big life changes that are going to happen in the next kind of 6 to 12 months? Are you going to buy or sell a business? Are you going to start doing some shares, buying or selling property? upgrade your owner occupied, buy an investment property, all of these things will be, I guess, a factor in your decision making on whether you're going to fix for 6 months, whether you're going to fix for 5 years. So another thing to factor in as well is your risk tolerance. So are you okay with fixing in a rate for now, and then 12 months time you see the rates that have either decreased 0.5%, maybe 1%? Are you happy with that and still paying what you're paying now, or are you thinking, oh, I should have fixed for that shorter term, and now I want to break my rate, and you're going to have to pay all these break fees? So it's just another thing to factor in. How are you going to feel when you see rates either lower or higher than what you've fixed for in the short term? Another thing is your time horizon. So if you own your own home now, how long is that going to be your forever home? If so, fixing for longer term might be a better option. If you're thinking of selling it or upgrading within the next 6 to 12 months, fixing for 3 years probably doesn't fit your goals. So that's just another factor to think about. And a big thing is structure as well. So does your loan structure need reviewing? So quite a good thing at the moment, especially when things are a bit uncertain, is kind of hedging your bets and splitting your structure. So not having your whole loan fixed on one rate. So you might fix a portion of that for a year, fix the other portion for 2 years. So, if rates decrease and you fix one for that 1 year, then you're going to benefit for that when that comes for a renewal. And then the same goes the other way. If rates start increasing after that 1 year, you've still got that other portion on the fixed for 2 years. So structure is a big part of it as well when considering a rate.
Yeah, absolutely. And I think too, like we see a lot of people come to us with, wanting to do something now or within the next couple of months, and sometimes their rates don't fit in with what their plans are. And so the first thing we always ask is why it's at the top there is what are your goals and what are you trying to achieve? And then we kind of balance that structure out around it. Another thing that we see a lot of is if we do have the sort of the downside, I suppose, to splitting loans or splitting lenders, is that if you do have a new lending event, so you're wanting to do a refinance or you're wanting to look at a new purchase and not everything's coming off at the same time, then you can be subject to break fees, and then that doesn't allow you to take on new opportunities at new banks or potentially a bank that has a structure that suits you better. So there are always pros and cons, and I think it's really interesting and really important to consider like what pros are more important and what cons are you willing to live with. So like today, for example, I had a chat with someone about an offset loan, and that's something we're talking about a lot at the moment, where people have savings and they're not sure what to do with them, or potentially they're buying a new property, and they've got a little bit extra, but they're not sure if they should just tip it back into their mortgage or if they should keep it available. And there's so many different options at so many different lenders, which can fit people's situation. And probably the last thing I'll just say here too is if you have got a bank, when you're considering things like lump sum repayments and increasing repayments or decreasing repayments, always check what that policy is with your bank. Every single bank has something slightly different, and therefore it makes it really important to make sure that you've got the right fit in that respect. So we're doing a lot of reviewing of structure is probably the point there. So we're going to cover off a couple of scenarios that we're currently seeing with clients. So these are all real people, obviously no names, but with some scenarios that we're giving advice on. So we're going to talk through some of the reasons why we're giving certain advice, and we're really open to questions around this. So if any of these people are close or similar to your situation and you're wanting some clarity, just jump into the chat anytime and I'll pick it up while Aaron's going through some of these scenarios. Cool.
So first one on there is the low debt, good income. So what we mean by that is they've got, say, a 200K mortgage. Their combined household income is 180K per year. So they tend to be less affected by changes to rates. They've got the more ability to pay off lump sums due to their, they've got more expendable cash from their higher income. Not likely to have any changes to the personal situation due to that low loan amount that they've got. And quite often a shorter loan term is going to work for them. With the 200K paying the lump sums, they're going to pay off their loan pretty quickly. So, fixing for the longer term, it just doesn't seem like a great fit for that one. If you've got anything to add to that one, Claire?
Yeah, no, that's great. Yeah. So shorter term to basically give them some more flexibility at the other end of the fixed term, and also to give them a little bit of flexibility as well if they wanted to increase or decrease repayments. Yeah.
Yeah. Cool. Family in midst of growth. This one hits home to me, really. This is kind of similar to where we're at. So yeah, about 600K mortgage. You've got one income, 150K, and then you've got part-time, maybe about 30K a year, with one child already planning for another. So this is where cash flow is probably going to be the most important thing for them. So they're likely going to want some certainty around what their repayments are going to be. And they're quite affected by the interest rate changes. And obviously the higher cost of living isn't going to help their cash flow there either. So thinking about maybe splitting a structure there, hedging some bets, or just putting it all on some longer term, just so they have some budget certainty around, okay, I know what my net payments are for the next 2 years while we're on that lower income. That's probably going to be best suited for them.
Cool. The third one here is an investor. So this is actually some advice that I gave a couple of weeks ago. So this investor had a personal home and 2 rental properties. So he was buying the second property at the time. He had pretty low personal debt. Most of the existing debt that he had, I think he might have had maybe 200,000 in personal lending, and then the remainder of it was in investment property lending, essentially. So this was actually a refinance application and a new purchase. So we were able to set things up exactly how we wanted to. So in this case, we actually set up the personal debt on a slightly shorter term. So I think it was about 1 year. And then with the remaining debt, we looked at a slightly longer term. So cash flow was actually really strong. This particular investor had 2 properties on the existing rental, and he was planning to put a secondary dwelling on the second rental property. So essentially he was going to end up with 4 properties, 4 income streams, and quite strong cash flow as a result. So the goal was to repay the personal debt first. So that was on a shorter term, lower interest rate, able to make repayments. So any money that was coming in that was kind of over and above the needs could be channeled into that space. And then they wanted certainty across 3 to 5 years. Now, this particular investor, we actually ended up fixing him for 4 years, which was a little unusual. I don't normally do that, to be honest. But at the time, the 4-year rate was actually significantly stronger than the 5-year rate. So that became the choice, and he was really stoked with that. It meant he got some really good certainty for that 4-year period. He wasn't planning to make any changes to buy or sell any other properties. He was just wanting to kind of bed in and get really set and continue to increase his cash flow, and also to add that secondary dwelling to the new property. So that's just a slightly different scenario, and then kind of I suppose the standard, but it just gives you a little bit of an insight into some of our thinking when we sort of talking to clients and giving some advice around refixing. The other one that I did want to just cover today, which isn't up there, but it is something that we're seeing quite a lot of at the moment, is people who are buying properties when they've got maybe a little bit more deposit than they need. So just to keep things simple, let's say they're buying $1 million property, 20% deposit is 200,000, and they've got 275,000 deposit. We're seeing a little bit of restructuring actually into the ANZ renovation loan, which has just come in a couple of weeks ago. We're seeing it into green lending, so buying a new home and adding things like solar or even buying an EV, but doing something to the property which is going to make it a little bit more energy efficient. So we're actually having them put a little bit more cash into the purchase, but then borrowing the money for the other purpose a little bit later on, or kind of adjacent to the purchase or to the refinance. So there's a few options in terms of loan structure in that respect as well. And we're also seeing a little bit of people who are wanting to make the most of having a reasonable amount of savings with some cash on board, but they don't want to actually pay off lump sums and commit that money to repaying debt just yet. than wanting to keep it there for a rainy day. So definitely something that we're seeing a lot of as well, is some of these ones as well. Oh, now Aaron's going to talk about all the opportunity that's out there at the moment.
Yes, because it is all about doom and gloom in the news, and even talking to other people in our industry, like the outlook on it seems to be a little bit negative, and we've always been known here at My Mortgage to be the positive bunch in a crowd. So when you think of the interest rates over the last 10 years, like we're still sitting at pretty much the average. Like it's still a good cheap rate. It's not going to be the 2.44%, 2.5%, but it's also not the sevens that we had, or 7.3s or whatever it got up to in a couple of years ago. So when you think about a 4.6 or 4.8, it's actually still quite low and quite competitive. Um, Property prices, we're seeing obviously it's a great time to buy. You've got more negotiating power with sellers now, so you can actually do some good negotiating and get a reasonably good price, on a property, not like in 2021 where there was about 50 people at one open home and it's a multi-offer and there's 12 offers and you just miss out. So it's while open homes and that might be slower at the moment, you've actually got better chance of getting a property for a good price. Upcoming election this year, so that's going to, everything's a little bit up in the air, but it also creates a bit more opportunity for things to change, and for other policies to come in that might help first home buyers again. We've obviously got the Kind Water first home loan. ASB have just jumped on board with that, which is another major bank for us, which is cool. So you've got Westpac and Kiwi Bank, who are the other main banks there that do that, and then there's some other lower tier banks that also offer it. But change of government might make it all banks that do it. Who knows? But yeah, there's always opportunity and reduction in rates. Yeah, we had rates coming down quite a bit last year, so overall quite positive still, regardless of all the chaos that might be happening in the world.
Yeah, there's always a way to benefit too, I think, from any challenge. And probably something I'd say if I'm reflecting across the 10 years in the industry, there's always something that's going to pop up, whether it's some sort of global unrest. We've had the war in the Ukraine, we've had the current stuff that's going on, we've had COVID. And then there's also some of those smaller things as well that pop up over the years in and around, like policy, the government policy, the changes in interest deductibility, all of those things. And my advice, or our advice, I suppose, is always just to make sure that whatever you want to do is not clouded by something that may or may not happen. Try to stick to your knitting. I had a great conversation with a first home buyer on Friday, and he said, "Oh, do you think it's a good time to buy?" And I said, "Well, 5 years ago was a great time to buy, mate, but like today, just as good." And he kind of laughed, and I said, "But that's only because the certainty that you have is only today. You don't know what's going on, and even in 3 or 4 months' time. So you've got to make the call based on you and your situation. I think that's really important." We've got a couple of questions here. We're at question stage, Aaron.
Cool.
Yes, a couple of questions here. So someone has asked, should I fix early or late? I think what that means is, so lots of banks will send you interest rate reminders or fixed rate reminders up to sort of 60 days before your fixed rate is coming off. So at the moment, we are actually sending out reminders to our clients who have got rates coming off in early June. So that's a reasonable period of time away. So I think the question is, should we be locking in today or should we be locking in later on? So Aaron, what do you think of that?
I think with the way that rates are kind of the longer term rates are slowly creeping up, there's the potential that those shorter term rates could slightly creep up as well. I think if you want the certainty of a rate that's being offered now, then I'd say lock in for those, as early as you can. If again, it comes down to your risk profile too. Are you happy to wait the extra 60 days? And if it goes up by 2.2%, are you still comfortable with that? Then just wait and see what happens. Like, yeah, it does come down to a bit of personal preference on if you're going to be really angry if things go up by 0.2%, I'd say probably just just get it locked in.
Crack on. Yeah. A couple of lenders too, they actually do like a rate promise. So they will actually give you the best rate for the term on the day, which is great, but not everyone does that. So that's cool. Another question here. I am selling but my rate isn't expiring for a couple of months. What should I do? Yes, okay. I'll answer that one. So we have got a couple of people selling at the moment who are settling kind of, let's say that I think I spoke to someone today who's settling in late May, and their rates are not expiring until the middle of June. So depending a little bit on whether you're at the scale or you're at the end of the scale of rate expiring first and then settling, I'll answer both. So basically what happens if you're selling before your fixed term comes up for renewal, the bank will always consider whether or not they are going to be missing out that they would have otherwise had. So we call that break fees or early prepayment fees. Essentially, if there's a short period of time, so let's say it's 2 weeks or a month, it's unlikely that those fees will be huge. I had one come back today for a settlement at the end of May, and their rate was due at the end of June, and there were no prepayment fees. So it depends a little bit on the situation, because it depends on what the rate is and also how long it's going to be between the time that you would have otherwise paid that rate and the settlement. If you are planning to sell, or you've sold and you're not settling until after your fixed rate expires, hope we've already got a pre-approval, then essentially you probably would look to float your loan between those two time periods, depending a little bit on whether there was any flexibility around that, as in around your settlement date. But yeah, basically it would be a floating rate. We can always get you a discount, so we can make sure that we can get the best available for you for the time period. And if it's floating for 4 months, that's fine. When you start to get to floating for 6, 8 months, that's when you start to probably consider whether or not fixing for 6 months is a good option. So it just depends. Some settlements are quite long. Like I actually had one today that was over a year. So just getting that really clear, whether that would ever change or is that locked in, that sort of thing, and then we can have a bit more of a specific chat about it and how it applies to you. So feel free to reach out. Cool. Have we got any questions? I don't think. Oh, yes. Here we go. Great question. If I have a longer time to run on the fixed rate, can I transfer the loan with the home as long as both settlements are contemporaneous or within a certain time frame, and assuming security and LVR stack up? Yeah, cool. So, yep, this is actually one. So I'm assuming that you've probably got quite a good interest rate. Your current fixed interest rate is probably quite good. We did actually have one of these earlier in the year. So let's say, just for argument's sake, currently you've got a fixed rate of 4.49% for another 12 months, or maybe for another 2 years, I think was the one that we had. So that's now lower than today's interest rate for 2 years that you could take out if you were taking out a new loan today. So if you have a longer time to run, can you transfer the loan as long as both settlements are on the same? Yes, you can. And assuming security and LVR stack up. So what they mean by that is assuming that the value of the property and the amount that you're borrowing is still meeting bank servicing requirements. So yes, you can do that. Probably one caveat, depends a little bit on your situation. So just if I refer back to the previous one that I was talking about, we had 2 years at 4.49 still to run, but another bank that was not their existing bank was willing to offer some cash back and some other benefits that they really liked. And so in the end, it's actually very similar for them to fix a new loan rather than continue with the existing one. So we always do a bit of a compare, because sometimes there are some other benefits or pros and cons of doing that. So, yep, definitely can do that. Okay, I'm going to ask this one and you can answer this one, Erin.
Yeah.
We're selling our house and looking at purchasing a rental property in another main home. Are you better to have no loan on your main home and the bulk of the loan on the rental property? This is not tax advice, but this is what we usually do. Go, Erin.
Yeah, so obviously for a rental property, the maximum lending you can have on that, which is set by the banks, is 70% for the investment property stuff. But you can have up to 80% on your main home, on the bulk of it. So what we generally do is we try and top up. We top up the lending against your main property up to 80%. Just gives you more deposit, I guess, to use to then make your purchase onto that rental property, so you're not putting in as much cash. Yeah. Anything to add to that, Claire?
And if the situation was because we're dealing with a couple of these at the moment, that you would have enough money to buy one of those properties outright, for example, then you would be better generally to have the rental property being the one that you borrowed the money against. And then there is probably also a couple of considerations here. So going back to what Erin said there around the 70% borrowing position on a rental, to obtain 100% lending deductibility on a rental property, you'd need another property to be held as security. So that's just means that you need a little bit of extra value. So he was talking about it in relation to a deposit. But if you wanted to borrow that whole amount for a rental property and you had purchased another one basically for cash, then you could use the security of that plus the new rental, 100% deductibility across all of the rental property lending. So there's probably a little bit of intricacy and definitely worth having a conversation about. But yeah, that broadly is the case. And generally, as the tax rules currently exist, and to get tax advice from a licensed tax person, yes, it would be better to have a rental property loan rather than a personal home loan because it wouldn't be deductible. Great questions. I am loving this. Love the specificity of this. It's awesome. And interestingly, giving quite a lot of advice to people at the moment who are looking to downsize like one big home into diversified. So to refer back to the example that I was talking about before, I've had a client sell a property for 1.8 and look to buy a kind of a smaller sort of lock and leave type and a commercial property just to diversify a little bit. And that's really cool because it's just something a little bit different at the big house that they once had. So yeah, lots of kind of just revisiting, looking at different options, and we're always happy to much better than me.
Yeah. Another thing we get quite a bit as well is like obviously they want to know, people want to know how much they can borrow, and it's generally better than what they thought, or they're not as far off as they thought.
Yes.
Quite often we're getting people pre-approved for way more and they're like, oh my gosh, I didn't realize I could actually afford that much. So we're seeing that quite a bit as well.
Yeah. And one of the things I often say to people is you're probably more limited by the amount you want to pay than the amount you can borrow. So we always look at, a standard rate. So maybe it's a 2-year rate or a 3-year rate, whatever we've talked about, to make sure that people are really clear on what's actually going to be their repayment. So it's not like, oh my gosh, this is a bit more expensive than I thought.
Yeah.
But there's always times as well where, you get people approved at a slightly higher level. It gets them into a slightly better suburb. It gets them into a slightly bigger house. They can have, a boarder living with them, or they can have a family member living with them. And it's actually got them into a better property with a very similar level of kind of cash flow position, I suppose. So yeah, there's always kind of intricacies around that, and we're happy to talk it through. That's great. Awesome. Well, are there any more questions? I'm just keeping a bit of an eye on the chat here. speak now or forever hold your peace, or reach out to Aaron or myself. So you can jump onto the My Mortgage website. Up on the top right, there's a contact page, and you can actually just jump into whoever's your advisor, or pick someone that looks fun, and book a call and have a chat about some of these things more specifically. But yeah, we really wanted to just cover off today how some of those changes were affecting interest rates, and just kind of what to expect so that you feel really confident to go into some, the next 3 to 6 month interest rate decisions going, yeah, cool, I know who I am, what I want to try to achieve, and I can pick a rate accordingly. But as always, individual advice is definitely the thing that we stack our caps on. So if you do want to have a chat, we'll send out an email tomorrow, and we'll actually pop our email addresses both in there so you can have a conversation, and we can make a bit of a plan for you. But otherwise, Aaron, thank you so much for jumping on with me.
No worries. It's been great. It's been great. And thank you to everyone for spending a bit of your evening with us. It's been great to have you.
Yeah, we've got a record number of people on, so it's very, very exciting for us. And probably the last thing I'll say is, if there is anything else that you would like us to cover in these webinars, even if it's a little bit more, structured type stuff, or anything that you think would be useful, please do reach out. We're more than happy to have some conversations about that. So yeah, until next time, thank you very much for joining us, and have a wonderful evening.
Cool. Thanks, guys.